With the UK's autumn budget set to be announced on October 30th, there is a lot of speculation about what changes will be coming and how they could affect your finances. With the reported 22 billion black hole in the budget, it is almost certain we will see tax rises. And the Prime Minister has already hinted that it will be painful. But which taxes are on the table and how will they impact you? By the end of this video, you will have a clear picture of what is coming and how you can prepare for these changes. Labour has pledged not to touch the three big personal taxes: income tax, national insurance, and VAT. Together, these account for 70 to 80% of all UK tax revenues. So, if they are not going to raise those, where is the money going to come from? Let's take a closer look at some of the areas likely to see changes. Number 1. Income tax freeze. Next, let's talk about income tax. Labour has promised they won't raise income tax rates, but they are likely to freeze the tax bands. Now, what does this mean for you? When tax bands are frozen and your income rises, even just to keep up with inflation, you end up being pulled into higher tax brackets. This is what is called fiscal drag. Let's look at how these changes could affect someone in real life. Take the example of Sarah, a 45-year-old earning $55,000 a year salary. As her salary rises due to inflation, she is gradually being pushed into the higher tax bracket thanks to the income tax freeze. Even if their increase in income has not improved their spending power, so while Labour is not technically raising income tax rates, freezing the tax bands is essentially a stealth tax that will pull more people into higher brackets over time. One estimate suggests this could raise around £40 billion over the next few years, making it a significant revenue driver. For most workers, the real impact will come slowly, a little bit, more tax taken from every pay rise, but over time it adds up. Number 2, VAT on private school fees. One confirmed change we expect to see in the autumn budget is the introduction of VAT on private school fees. Private education is exempt from VAT, meaning parents are not paying the 20% tax that applies to most goods and services. Labour plans to change that, adding a 20% VAT charge to school fees. Now, let's break this down with an example. Let's say a family pays £15,000 per year in school fees. With the new VAT, they would be looking at an additional £3,000 in taxes. That is a significant extra cost for families, already sparking reactions. Labour estimates this measure will raise 1.6 billion annually. While that sounds like a lot, when there is a 22 billion pounds hole to fill, it is barely a dent. Any private school fees paid after 29 July 2024 for tuition and boarding fees covering a period on or after 1st Jan 2025 will be subject to 20% VAT. Or any fees prepaid before 29 July for tuition and boarding from 1st Jan 2025 may also be subject to 20% VAT depending on the arrangements that the prepayment scheme made. Let's continue the example of Sarah. If her children go to private school, she is now facing an extra 20% in VAT on top of already high fees. Number 3, pensions in the spotlight. Now, pensions. This is where things get a bit more complicated, but the changes could be major. Currently, contributions to pensions receive tax relief. The higher your tax rate, the more relief you get. For a basic rate taxpayer, you only need to put in £80 to get a £100 pension contribution, but for a higher rate taxpayer, that number drops to £60, and for additional rate taxpayers, it's only £55. Labour is looking at capping this relief at 30% or even lower, meaning that high earners won't get the same level of tax relief they have been used to. For example, if you are a higher rate taxpayer contributing £60 today to make up £100 in your pension. Under the new rule, you might have to contribute closer to £70 or more. Over time, this will significantly affect your ability to save for retirement, especially if you are in the top tax brackets. Some estimates suggest changes to pension tax relief could raise between 15 to 30 billion annually. There is also talk of scrapping the tax-free lump sum you can withdraw from your pension at retirement. Right now, you can take up to 25% of your pension pot, up to 268,000, without paying any tax on it. Ending this relief would be another way for the government to raise funds, but it would have a huge impact on those planning to retire soon. Like in the example of Sarah, she also contributes to a pension and takes advantage of the tax-free lump sum, which might no longer be available when she retires. Number 4, non-dom status. Another target in this budget is likely to be non-domicile or non-dom. This allows UK residents whose permanent home is abroad to avoid paying UK tax on their foreign earnings. It is a legal loophole often used by wealthy individuals who live in the UK but earn significant money overseas. For example, a non-dom living in the UK might only pay taxes on their UK income, even if they are earning millions from investments abroad. Labour is looking to close this loophole, estimating that this change could raise around 2.6 billion throughout the next parliament. But with the UK spending nearly 1 trillion annually, this is still just a small piece of the puzzle. While non-dom status doesn't affect most people directly, it is part of Labour's broader effort to ensure that wealthier individuals contribute more to public finances. Number 5, capital gains tax. Finally, we have capital gains tax, another area that could see significant changes. Right now, capital gains tax rates are lower than income tax rates, which makes it a popular way for wealthier individuals to build wealth while paying less tax. For example, if you sell an asset like a property or shares for a profit, you pay capital gains tax at a rate of 10% for basic rate taxpayers and 20% for higher rate taxpayers. Labour could choose to align capital gains tax rates with income tax rates, meaning you would pay up to 40% or even 45% on profits, depending on your income bracket. There is also talk of taxing only gains that are above the rates of inflation, which could be a more targeted approach. For example, if you sell an investment that has gone up in value due to inflation, you would not be taxed on that portion of the gain. Aligning capital gain with income tax rates could raise an estimated 4 billion per year, another significant revenue stream for the government. On top of that, for example, if Sarah sells her investment property in a few years, she could face significantly higher capital gains taxes. Conclusion. As we look ahead to the autumn budget on October 30th, it is clear that tax changes are coming and they could have a significant impact on everything from your pension to your school fees, while Labour is aiming to protect the big three taxes: income tax, national insurance, and VAT. They are targeting smaller areas like pension, ISAs, and capital gains. These changes may seem small individually, but they add up quickly. We will be covering the autumn budget in full once it's announced, so make sure to subscribe to stay updated on what is coming and how to prepare. So stay tuned. Thanks for watching.